All right, we're going to do the work together 13-1, and it gives us the directions here and provides us information from the balance sheet, statement of equity, income statement that we need in order to do this, and it has current year and prior year. So I'm not going to probably flip back up to that. Then it gives the summary table, which I've already put the calculation and answers in for. So I'll let you pause this and copy that. And then down below I have all of the calculations, and I only did what the formula is and the current year numbers. To get to the answer, you'll have to do the prior year on your own. So I will go through all those at the end, but I just want to do the analysis part first. So for working capital, these first three are your short-term financial strength ratios. The final four are the long-term financial strength ratios. And again, it's our ability to generate enough cash to pay short-term obligations, liabilities, and then to pay long-term obligations or liabilities. So, excuse me. So let's just make sure we understand. Those are the ratios. They provided the target range for this company, what their low and their highs are. And that's what we're going to use is compare our actual to targets. So then it asks for our favorable trend and our favorable result. So the trend is just saying from prior year to current year, is it getting better or worse? So the trend is prior year to current year. The result is, given where we are right now, are we within the target range? Okay, so for working capital, it is going up. That is the trend. That is a good thing. It is at 986,000. That is between our low and high, so that is a good thing. Our current ratio, it is going from 2.1 up to 2.6. That is a good thing. Then we're at 2.6. It's in between for us, so that is a good thing. The quick ratio, it's going from 0.7 to 0.8. That's a good thing. It's at 0.8. It's not in our range. That is not a good thing. The debt ratio, 44.8, 41.7. The debt ratio is going down. We're borrowing less. That is a good thing. It should be between 38 and 42. It is. That is a good thing. The equity ratio went from 55 to 58. It's going up. That is a good thing. We want it to be between 58 and 62. It's at 58.3. It's in the range. That is a good thing. And let me just note again, in case you forgot, these two added together should be 100%. So you know that when you calculate these, when I add for the current year, those two ratios, debt and equity, they equal 100%. These equal 100% in the prior year. So then the common equity per share, it's going up. That's a great thing. Is it in our range? We want 1550 to that. No, not a good thing. Not strong enough. And then finally, the interest coverage ratio went from 14.8 to 14.9. That is a good thing. I'm covering interest better. But am I in the range? No, that is not a good thing. And so our directions asked us to list two ways that this company can increase its interest coverage ratio. So it makes us analyze and say, so in order to get this to go up, what can I do? So if I'm down here looking at the interest coverage ratio, I am taking EBIT divided by interest expense. So one way that this company could improve their interest coverage ratio would be to increase their net income. If they increase their net income, that's going to drive up EBIT. That's going to make the numerator be higher, and that's going to make my coverage ratio increase. So that's one way I could do it. Another would be to decrease interest expense. So assuming EBIT stays the same, if this denominator went down, my coverage would also increase. So that is a good thing. So that takes care of analyzing everything. I'm going to be quiet here and just move down so you can copy what you need to if you want each of these ratios. So we'll start with working capital and current ratio, which you can see, and do the prior year as well as you're going. So I have put the result in for that prior year now. So now I will go to quick ratio and debt ratio. Quick and debt. Now I will move to the equity ratio. And again, don't forget the 41.7 and 58.3, adds to 100%. 44.8 and 55.2 add to 100%. So then the common equity per share. This is a long one. So first we come up with the preferred stockholder share. The prior year it's going to be 100,000. I think I have enough zeros. And then I come up with the just common stockholder share of equity. And again, you can pause if you need to copy and see how you're doing. And then finally, we come up with the common equity per share, which is 13.30. Then the interest coverage is a two-parter. We're going to come up with the EBIT. And EBIT is 115,484 in the prior year, which 14.8 when we calculate it out. So there are obviously a ton of ratios, and you have to be able to know how to compute all of them. And if we look at working capital and current ratio, the thing that we would notice about it is we're always dividing by total current liabilities, because again, it's the short term or current financial strength. And then the debt and equity, we're dividing by total assets each time. And then the others, it's harder to kind of draw just similarities between them. What I would also know is that I always want working capital to go up. I want current and quick ratio to go up. I want the equity ratio to go up. I want common equity per share and interest coverage all to go up. The only one that is more favorable going down is the debt ratio. I don't want to borrow as much as or borrow more to cover the cost of the assets or the ownership of the assets. So that's kind of what I would draw out of this if I were you. And then you're going to have to know how to improve these things. And again, you're always just trying to figure out how to improve them based on the calculation itself. Making the numerator higher if we're dividing something, making the denominator lower. So think in those terms when you're given choices. this is a huge deal, doing ratios. And if you get good at this is, and being able to analyze what this stuff means, that's when you become a great accountant.